If you bought a commercial or rental property in the last 3 years and you did not run a cost segregation study, there's a real chance you left serious tax leverage on the table. Not because you made a mistake. Most investors simply follow the default approach their CPA gives them and move on. But here's what almost nobody explains clearly. The default strategy is built for simplicity, not optimization, and simple is often expensive. So today I want to walk you through what cost segregation actually does, when it creates real leverage, and when it creates problems instead. Because if you treat it like a flashy write-off strategy, you're thinking too small. But if you're evaluating it like a capital allocation decision, you're thinking like an operator, and that shift changes everything. Let me put real numbers on this so it actually makes sense. Say you buy a $2 million commercial property. Under the default approach, you depreciate that building over 39 years, nice and slow. The IRS loves that for you. But here's what most people do not realize. Not everything in that building depreciates the same way. The electrical, the flooring, the fixtures, the cabinets, the parking lot, those are not the same as the walls. They have shorter useful lives, like 5 years, 7 years, and 15 years. A cost segregation study identifies those components and accelerates the depreciation on them into early years. So on a $2 million property, you might have $600,000 or more that qualifies for accelerated treatment. And in a high tax bracket, this is not a small shift. That is liquidity sooner. Here's the key distinction. So I want you to really hear this. Cost segregation does not create deductions. It accelerates deductions you already have. Timing, it's the whole game. So let me give you a way to think about this that actually sticks. Imagine you buy a fully outfitted work truck. The engine, the tires, that tool racks in the back, the lift gate. Are you really going to depreciate all of that on the exact same schedule? Of course not. Equipment has different useful lives. A building is the same way. We just do not talk about it like that. Your property is not one asset. It is a collection of assets wearing one price tag. Cost segregation is just precision, and precision creates leverage. Now here's where I'm going to say something most influencers skip because it does not get as many clicks. The deduction is not the win. Redeployment is the win. If acceleration frees up $200,000 in liquidity, what are you going to do with it? Another acquisition, reserves, paying down high interest debt, funding business expansion, because acceleration without a capital plan is just noise. Acceleration with a capital plan, that is strategy. This is the difference between operators and amateurs. Amateurs ask, how much can I write off? But operators ask, where does this freed up capital go next? And if you do not have an answer to that second question before you run the study, you are not ready for the study. Now let us talk about where this actually blows out, because I've seen this happen all the time and it's very painful. Real estate losses are generally passive losses, which means if you are W2 heavy or you do not qualify under specific rules, you might generate a massive paper loss and are not able to use it. Not this year, not next year, suspended, just sitting there. So you did the study, you paid for it, you accelerated the depreciation, and your bank account did not move. That is not cost segregation failing. That is planning failure. There are legal ways to qualify for those losses, such as real estate professional status, the short-term rental exception, strategic grouping elections, but this is critical. Those have to be structured before you accelerate. Acceleration without qualification planning is like buying a sports car with no engine. It looks like a great move and it goes absolutely nowhere. Now, we need to talk about the part nobody brings up until it's too late. Depreciation recapture. So when you accelerate depreciation, you reduce your cost basis in the property. And when you sell, the IRS recaptures a portion of that accelerated depreciation, often taxed up to 25%. Now, does that make cost seg a bad strategy? No, it makes it mathematical. So if you're planning to sell in 2 years, acceleration might not be optimal. The math may not work in your favor. If you're holding long-term, refinancing, or executing a 1031 exchange, the equation completely changes. Your exit plan determines whether the move was intelligent. Always. This is why I never look at cost seg in isolation. It has to be evaluated inside the full picture of where you're going. So here's how I actually evaluate cost segregation with my clients. I use 4 variables and all 4 have to align. 1, income profile. Do you have the income to use these losses? And do you qualify to use them this year? 2, holding period. Are you holding long enough for this to make sense before recapture becomes a problem? 3, exit plan. Sales, refinance, or 1031, each one changes the math. And 4, capital deployment. What are you doing with this freed up capital? Because if the answer is nothing yet, we're not ready. If all fours align, cost seg is a powerful tool. Even if one is off, you're just shuffling deductions without purpose. Most people focus on this year. Strategy focuses on positioning, and positioning compounds. So before you run a cost segregation study, I want you to be able to answer these 4 questions cleanly. What is my holding period? What is my exit plan? Do I qualify to use these losses, and how? And where does the freed up capital go? You cannot answer all 4. You do not need to study yet. You need planning. Cost seg is not a loophole. It is not aggressive. It is not a hack. It is precision, and precision compounds. If you want content like this, strategy over hype, subscribe. I drop this every week. And if you're a business owner with multi-entity income and real estate in the mix, and you want strategy layered into every move, this is exactly what we do at HavenStone. The link is below. Let's talk.